Well, thanks for having me, Rich, at least virtually. This is kind of the world that we live in for, I think, the foreseeable future. And just very quickly, I wanted to put a face to the voice behind this, and so I hope this does make it through to the recording as well. And if you've attended any of the previous webinars that Rich and Mid-Plains posted, you'll know that AgResource, we're very long-term, big picture. We have no affiliations with any brokerage. We don't do any trading. So our incentive, we stay in business only if we get markets right. So we will give you the outlook, whether it's good or bad. And now, and for the last couple of years, it has been pretty negative, but we think that it's worse to ignore that than to acknowledge it. And so really the fundamental outlook previous to the arrival of COVID-19 wasn't terribly rosy. And this is put, kind of a further damper on things. So this will be basically going through trying to, as best we can, quantify the impact of COVID-19, as well as record global crude oil production. I think those are the two big things that are going to impact the U.S. ag markets well into 2020 and perhaps beyond that. So we'll just get started. And again, the previous forecasts have always been about production offsetting consumption. And in the past, we've talked about accelerating yield growth in emerging markets. So Brazil, Ukraine, Russia, Argentina, they're getting better at growing corn, soybeans, and wheat. In some cases, they're matching our yields. Brazil's soybean yield will get very close to the U.S.'s. Russia's wheat yield in 2016 and 2017 matched U.S. hard red winter yields. And so that probably continues. So now Ukraine and Argentina will start to catch up to match U.S. yields, and we think that's bearish long-term because we don't see any major demand. One of the big issues that we've been focusing on really in the last 8 or 12 months is that the U.S. has spent all these billions of dollars, $14 billion on MFP, disaster insurance. So it looks to be about $30 billion allocated to U.S. ag, kind of a slush fund from these recent stimulus packages. To help appease the farmer, which is incredibly important, and we are very grateful for that. And I want to, note also that this negatively affects our outlook as well. A lot of our revenue is based on U.S. farm income, so we don't like to tell people this, much less hear it. So I understand everyone's frustration. But the issue is that no money has been spent on stimulating demand. So we put Band-Aids on a lot of this stuff, but if we're going to get a major recovery or shift in the structure of global ag markets, we need to see a demand driver, which we don't as yet. So the near-term issues, the two biggest issues from this COVID-19 and Russian-Saudi crude oil price war are the lack of miles being driven and the near complete shutdown of restaurants and food service industries. So when does the market return to normal is the question. I know there's a lot of optimism in the financial markets, the Dow, the S&P, because the curve is flattening in terms of new COVID-19 cases, total deaths, but that's only happening because of the social distancing that we've all gotten used to in the last couple of weeks. The next plan is unknown. When the curve starts to move down, what do we do? And I don't think we can get right back to normal activities because the virus probably comes back right away. So that's sort of the question is, we can flatten the curve very easily through social distancing. What's next after that? So the issue too for the lack of restaurant traffic, fewer miles driven, higher end foods are consumed at restaurants, of course. Well, that's not the case now, especially as unemployment claims rise. We're really concerned about the unemployment rate over the next 3 to 6 months. Cheaper meat, cheaper food will be consumed more often in the next several months. And also, we suspect there's a lot more food waste when eating at a restaurant, in the aggregate. And so that's not good for anyone, especially the environment, but it is what it is. And if we're not eating at restaurants, total global food demand and consumption will go down and stay down as long as the social distancing continues. Food service also lacks access to schools, which are closed. Sporting events, a lot of major sporting events, including the Olympics, have been canceled or postponed. That stretches from the NBA to the Kentucky Derby. And so all of those food service industries will be kind of in peril until all that gets back to normal. And because of this, we're running up against sort of processing capacity. So there's nowhere to go with record ethanol stocks that we have now. That continues. There's been nowhere to go with new milk production. To some extent, the livestock industry is struggling as demand for hides and carcasses is down, and we just cannot process enough. So will OPEC production cuts stabilize the energy market? We're hearing today that we will see maybe a 10 million barrel per day cut. They've agreed in principle. Will it actually happen, and will it have an impact on biofuel margins, which are doing pretty bad currently? The secondary issue is just sort of general normal fundamentals. So we had a largely favorable Southern and South American growing season, decent vegetation health we see currently across the Northern Hemisphere. So that's really a gauge on wheat potential more than anything else. But we are seeing positive soil moisture anomalies across the US and in India and China, a lot of Europe, and even for now, parts of the Black Sea, which are getting dry, but there's just no major weather issues at present. We're also looking at, neither La Nina nor El Nino during the heart of the U.S. growing season. So the odds of a Midwest drought are as low as they normally are. So, 1 in 10. We just don't see that probable scenario is widespread heat and dryness across the U.S. plains and Midwest this summer. So we'll get kind of right into it. So as we started to digest the impact of COVID-19, clearly we were expecting a decline in consumer spending, and then this is Foursquare data. So, you check in to make sure your friends know that you're having fun and you're not, and they're not. But if we aggregate this, we can see that in a lot of major population centers, casual dining started to go down, anywhere from 10 to 20% from February 19th to March 13th. So we're starting to see this play out. But at the same time, as coverage of the virus grew, death tolls are rising in Italy, and of course it already happened in China. We're seeing kind of the initial panic buying start to happen in the United States. So grocery store traffic surged in these major population centers. And so people were stocking up, buying bread and milk, meats of all kinds. But what changed there was we didn't really add to total demand for these food products. We just changed consumer shopping patterns. So we saw basis in Kansas City at a Kansas City flour mill rise 60 cents in 1 week because we needed to restock bread shelves. We saw meat cut prices rise dramatically during the second half of March. Even dairy was stable despite record February production during the second half of March. But all that changed as we started to sort of see the snapback effect. Because again, we weren't consuming more things, we had just purchased them all at once. So it starts with retail milk prices. Half gallon went counter seasonally rallied to $2.55 per half gallon. But then very quickly, because we weren't consuming more milk just because COVID-19 existed, we were just buying more all at once. So then the price of a half gallon of milk nationwide collapsed to $1.38. When this data is updated, hopefully today or tomorrow, this should show a national average half gallon milk price of $1.15 to $1.20. And we could go through all of the beef and pork cuts, but they're all generally the same. We just want to show the relationship that we had this spike in a lot of cuts during the second half of March, only to have that completely offset in the week following. So again, because demand has not changed, there's only shopping patterns. So ribeyes hit $8.30 in late March, but then fell to $6.80 very quickly after that. And so the issue is, do we have enough consumer demand at the grocery stores to keep prices elevated, or will we see a steady trend down in meat prices just because we cannot keep up with, we can't keep the processing lines going, and without restaurant traffic, we eventually will start to consume total less meat and food products as a whole. Because the ultimate impact, we saw the decline in casual dining, Foursquare during the second half of March. But then using open table data, again, aggregated by people checking in, online bookings, California issues it the first of 50 states, the stay-at-home order on March 19th, and just prior to that, U.S. restaurant traffic fell 90% year over year. Very soon after that, restaurant traffic shut down entirely. So this just shows that restaurant traffic year over year is down 100% and has been since about March 20th. And so why that's important is because we can track consumer spending patterns on food. This shows the spending patterns on a monthly basis since January of '97. And most important that we see is the gap between money spent on food at home and food away from home was fairly wide, but then started to narrow as we started to recover from the 2008-2009 recession. And we don't really know why that's the case, but that's been the trend in consumer taste since then. And as of late 2019, more money was being spent on food away from home than was being spent on food at home. So we suspect there's a lot more waste at restaurants than at home. And even, Heineken stated this week that beer sales were down 30%, which is somewhat counterintuitive. We think we have all these shelter-in-place orders, more beer will be drank. But again, there's this relationship that when people are out of the home at a bar, more beer is consumed. And the same thing happens at food and with restaurants. Populations in general tend to spend more, eat more, drink more when they're outside of the home. So that is why this hit at the worst possible time, just after food away from home dollars exceeded food at home dollars. We're also seeing a change generally in the way food is delivered from the farm to the table. So the retailer influence, the big grocery stores, their influence has been declining over the last decade. While food service has been steady, all others starting to rise. And so the spike in grocery store demand simply couldn't be handled briefly, but now people are probably starting to catch up. And so let's say, for example, grocery store demand has been more or less satisfied for the next 2 weeks, 30 days. So this will work to slow kill rates. Animals will continue to be fed, weights are rising, and the sort of bearish snowball effect in the meat industry has unfolded. And the same is true, in the dairy market too. So we're consuming less cheese. We're not drinking any more less fluid milk. But because some of the processing plants too have been, on a daily basis lowered because we need social distancing, some people cannot report to work. We're very concerned that COVID-19 affects these processing plants. There was just nowhere to go with milk. So for the first time in years, large-scale dairy operations have started to dump milk. This started last week. And two, if you think about, not just restaurants consuming cheese, I guess some milk, but, across the U.S. and across the world, all coffee shops, cafes, coffee in the office, that's not being consumed. And when added together, that has a very, very big effect. And the same is true when, we have large bakery clients that have now been forced to cancel existing contracts, whether it was for oats, flour, soy oil. Butter that's being delivered to them today has to either be frozen or, in some unfortunate cases, sold back into the market at an extremely cheap price. So everyone's losing money on it, whether it's the ethanol producer, the dairy operation, livestock feeders at the moment. This is supposed to be a much better year for the livestock and dairy industries, but COVID-19 has disrupted all of this. So this is what's actually happening in the physical food markets. And so the futures will digest forward-looking guidance, analysis. Do we, get out of this at some point? And I think that's true. I think a lot of us have faith that better days are ahead. But we know that stay-at-home orders will continue into at least the end of April. And if that's the case, we'll continue to dump milk. The ethanol will have nowhere to go, and so the physical cash markets will continue to struggle. This has been the first and most important impact on U.S. ag that we have seen since the arrival of COVID-19, because simultaneously, Russia has decided that they want to attempt to boost their share of crude trade and perhaps put the shale producer in the U.S. out of business. So we've got a record global crude production, no one driving any miles at present, and so we just had this collapse in ethanol margins. This is the worst it's been since 2012, and as a reminder, in 2012, from May to the final numbers, the USDA was forced to lower their corn ethanol demand draw by about 400 million bushels. And so we think a similar thing is happening now once this is all resolved very quickly. And the issue too is that ethanol has a pretty steep premium to RBOB and CBOB gasoline, which has been rare. So the producer of ethanol is not making money, and the blender of ethanol is also losing money. And even if these were to reverse, no one's driving, and so we just cannot have any alleviation in these, building and record stockpiles. And again, all this is very unfortunate because as of 2019, we were driving a record amount of miles per day in the United States. So 8,955 miles per day were driven. The forecast for 2020 was just over 9,000 miles per day. And even at not cheap gasoline prices, this is looking very, very healthy for the energy market. But we think that, by, when all is said and done, this will be closer to 8,000 miles per day. And so this will reflect really the first year-over-year contraction since the 2008-2009 recession. We think that all this will behave very similarly when isolating certain markets, particularly energy. And the data is now starting to back this up, and it's even been a little surprising to the downside. We knew a giant cut was coming at 30% of capacity is idled. But as of last week, the U.S. produced only 192 million gallons of ethanol. And that's the lowest number since the EIA began keeping weekly records of this. This number will be very fluid. A lot will depend on whether the stay-at-home orders end in May or June. But if we were to extend last week's grind rate through the duration of the old crop corn marketing year, we think that final corn ethanol demand could fall to 4.6, 4.7 billion bushels. And that's down another 300 or 400 million bushels from today's USDA update. So the general theme is that the old crop corn balance sheet is getting looser. We know we planted or intend to plant more acres, and so just how loose does the new crop U.S. corn balance sheet look using probable scenarios, average abandonment, and trend yield? And again, since we're not driving, none of this really matters. We could lose more ethanol production on a weekly basis, and yet we're continuing to build stocks. So production last week was record low. U.S. ethanol inventories as of last Friday were record high. Assuming last week's consumption rate, which will be fluid as well, this reflects about 8 weeks worth of consumption. Typically stocks of ethanol are worth about 2 or 3 weeks of consumption. And so we're really fearing that we're going to run into storage capacity issues. And then what does the price of ethanol need to be to clear excess supply from the market? And then what does that mean for ethanol margins today and in the future? Forward ethanol margins are negative throughout 2020. So do we need to idle 40% of capacity, 50% of capacity? We do know that some plants are breaking even, or at least revenue is matching variable costs, but in those locations, the price of cash corn has fallen to $2.85. So that's kind of the benchmark if the U.S. ethanol industry is to stay somewhat alive over the next 30 to 45 days. And this is a global phenomenon, which again is unfortunate, the timing of this, because we were growing corn-based ethanol production in South America and in Europe. First, we export or have exported a lot of ethanol to Brazil, especially at certain times of year. In calendar year 2019, the U.S. exported 340 million gallons of ethanol to Brazil, and that was worth about 120 million bushels of corn. Moving forward for the second half of 2020, could that be zero? And then that's what we're really concerned about. Second thing is that Brazil was, as they produce more corn and have this large domestic surplus, they were growing their corn-based ethanol industry. So our people in South America estimate that Brazilian ethanol plants would consume about 6 million tons of corn in 2020. That probably will be cut in half. Europe also uses about 6 million tons of corn to make ethanol, and already we're seeing that will be cut in half at least through the first week of May. So stocks of corn, or the perception of stocks of corn, are rising in the United States very quickly, and they're also rising in Europe and South America. So this issue is being compounded by lower global domestic use for corn. And again, I mentioned we had mostly favorable South American weather. The Brazilian winter corn crop, which is about 70% of Brazil's total corn crop now, and their entire exportable surplus, looks pretty good. That crop will be pollinating in the next 30, 40 days. This shows the USDA's latest crop mass vegetation health compared to normal. The black circle shows about 90% of the safrinha corn area. The red circle shows about 75%. So 75% of the winter corn crop in Brazil is in very good shape. The forecast looks to be pretty normal. And where the red circle is, it's very hard to build drought there, between now and the end of May, just because of its tropical latitude. So we think that there will be almost daily showers in those states, Mato Grosso, Goiás, Minas Gerais, well into the opening or middle part of May. So it's just going to be very hard to lower total 2020 corn supplies at the same time that we are losing industrial consumption. And in the U.S., we have a long way to go. The crop is not even planted except for in the deep south. But there is no shortage of soil moisture. You can see that the Palmer Hydrological Drought Index anomaly is on par with last year, which can be worrisome in some sense. But certainly, building drought, building heat typically requires short soil moisture reserves, and that will not be the case between at least now and the middle or latter part of June. So any yield loss or supply loss that has to occur to equalize supply and demand probably comes through, again, potential delayed seeding dates or just outright not planting, since I think a lot of U.S. farmers are incredibly frustrated after last year. And also, prevent plant probably looks more attractive given current prices and even guaranteed insurance rates. So that's a big risk. As a cool front comes across the plains and Midwest next week, but we don't think it will be a major yield issue, corn and soybeans this summer. So that's more or less the effect that COVID-19 and a record global crude production has had on the markets. And now we put it all together and make what we think is a probable U.S. balance sheet for corn and soybeans. This is what it looks like. And these numbers won't be terribly precise. They'll all be changing over the next 6 to 8 months. But the perception of these numbers needs to change dramatically if we are to have kind of a lasting recovery in corn and soybean prices. Corn especially. I think corn will be the bearish laggard in 2020, potentially 2021 if there's not a South American weather problem. So this is actually fresh, new, includes today's USDA update. So the USDA raised old crop corn stocks because they lowered total industrial use. We think that they will lower industrial use again. Feed use will be raised slightly, but the primary issue is that old crop stocks of 2.2 billion bushels is not bullish relative to 330, 350 corn. But then lingering in the background is this new crop balance sheet, which even being conservative on yield gives us ending stocks of well over 3 billion bushels next year. And so the question is perhaps, is this reality? Could we see a yield, could we see lower acres or a yield sub 170? And that's all very possible. But what does yield need to fall to turn corn bullish? So as we lose supply, perhaps because of droughts, we know we'll also use feed and residual use. From about 3 out of 10. So what you lose in yield, 30% of that loss will be taken out feed use as well. And so we think that final yield in the U.S. corn yield has to fall below about 155 bushels an acre to pull ending stocks in 2020 below 2 billion bushels. So just kind of an arduous chore, especially if we do seed all these intended acres. 97 million intended. We think it might be 96 because it's been too wet across the south. But again, these are all just minor changes. You still end up with 3 billion bushels of corn. So there's still probably 50 cents of weather premium in December 2020 corn futures. We do know that the stocks to use correlates very tightly with the average cash price in any given year. And notice that the curve does get very flat as stocks to use rises. It's just human nature. There's less attention paid to markets when stocks are abundant and overabundant. A big increase in stocks does not mean a big drop in price. Once you get to this part of the curve, I think stocks to use above 12 to 13%. But our stocks to use of 23% is, giving the benefit of the doubt even, is probably 285 cash corn on a national average basis. And so that's hard to hear, and it's a negative outlook. But we just know that there will be some better pricing opportunities. Out of the money call options look attractive to us selling those. And we even wonder if selling 360, 370 December corn on any weather-based rally this summer probably makes good economic sense. So the market is cheap now, but without a weather problem, it gets even cheaper. And that's kind of the message we want to send to the U.S. farming community. And so again, those balance sheet numbers won't be terribly precise, at least altogether, but again, the perception of this new crop balance sheet has to change dramatically. And because we're losing demand, not adding demand, that has to come through supply dislocations, which again, we think probably will have to be a function of acreage loss or delayed seedings, not a summer drought. And then perhaps more importantly, we know that markets have become more international, so it's it's the sum total of the world balance sheet or the exporter balance sheet that really determines price. And the 2020 balance sheet is mostly a function of changes in the United States. But assuming normal weather here, trends in yield and consumption in other major exporters, so that's everyone from Ukraine to Brazil to South Africa. Normal weather gives us ending stocks combined in the exporting countries of 100 million tons. That's up 35 million tons from the current year. Stocks to use of 17% also suggests an average cash price in the United States of $3, maybe a little bit below. And so that is why the corn market is struggling, and that is why we think it will continue to struggle throughout 2020. And we could get bounces, weather-based rallies, but we want to plant the seed that those are selling opportunities, not places to buy, even if weather turns very, very bad in June, July, August. On the other side, we are looking at relatively better fundamentals for soybeans. So biodiesel production probably falls not as much as ethanol, but does decline. Soy oil use in biodiesel production also declines. But margins, assuming cash prices this week are not negative, they're actually sizably positive. I think the biodiesel price so far has held in pretty well. Soy oil is very cheap, and so plants are making money if they produce biodiesel. The issue still is that we're not driving, and so where does the biodiesel go once it's produced? But at least this looks better than the U.S. and global ethanol landscape. China has also more or less gone to the other side of the COVID-19 crisis. Businesses are opening, travel is resuming. The trade war so far has been alleviated enough that we think normality returns to global soybean demand and global soybean trade flows. We've seen that 2019 total Chinese soybean imports were up on last year. And we are not alone in projecting 2020 Chinese soybean imports above 90 million tons. And what's important too is that as the hog herd begins to recover, it's also consolidating. So the small pork producers and small hog farmers cannot afford to jump back into the market today. So that leaves only the bigger and more efficient operations. And that phenomenon by itself probably boosts the demand for all kinds of oilseed meals, all kinds of oil seeds. And so that's kind of back to where we were, pre-trade war, not above trade war levels, but China will buy 35 million tons from Brazil, another 5 or 7 million tons from Argentina during the spring and summer. But then they, like 3 years ago, will shift back to the United States starting in August. And we think that they could buy 30 or 35 million tons, maybe more of U.S. soybeans in 2020, 2021 year. So that's at 1.1 billion bushels. And that's more or less back to where we were prior to 2018, and that's a positive. And also thinking that they only bought 13 million tons so far in the 2019 crop year, it's just a very big jump. And so global soybean demand and U.S. soybean demand probably rises in spite of the the Russia-Saudi crude war, and also in spite of the spread of COVID-19. And as mentioned previously, the plunge in weekly ethanol production has allowed DDG prices to soar. This is very good for meal. It might be too expensive currently, but we know on the margin that meal demand in the U.S. and Brazil and South America will be rising. So that's also positive for crush margins in the U.S. and soybean demand on whole. And this is kind of what we calculate the future or the next couple of months looks like for U.S. DDG production. So we're going to go from normal, which was 3 to 3.5 million tons or so during the spring and summer, to 2 million tons of DDGs produced per month. And it's just a major, major change. And actually, for an annual, September to August crop year, we could lose 3 million tons of U.S. DDG production, we think, maybe 3.5 million tons. And so that feed demand will have to be replaced with something else. Probably a lot of it will be replaced with corn, but again, on the margin, this is positive for U.S. and global meal. And so if we were to put all this together, NASA's planting intentions, changes in export demand, the consolidation of China's hog and pork markets, we do come up with, a not as bearish U.S. soybean balance sheet in 2020, despite everything that's happened. So we think that production rises considerably, and we may be adding to soybean acres across the South. It's just been very difficult to plant cotton, to plant corn. Those optimal planting dates really close in the next 5 to 7 days. Only 15% of Mississippi's corn crop is planted as of last week, and so a lot of that probably gets abandoned and shifts to soybeans. But either way, we still have demand growth in soybeans that we don't have in corn. So we think that new crop U.S. soybean in stocks will be fairly stable, between 450, 500 million bushels. There's probably more to go in raising old crop soybean in stocks, just because the pace of export sales and shipments is just so far still behind what it needs to be. But stocks to use next year of 11%, that keeps soybeans really broadly in an $850, $950, $975 commodity. So there will be better opportunity than soybeans. Now, looking farther down the road, do we plant a ton more soybeans next year and plant less corn, and all this relative balance sheet tightness is washed out in 2022? But for now, soybeans probably continue to gain on corn, as does wheat. Corn really will be the laggard. If there's any message that we can present today, it's that corn has very little going for it now and for the next potentially 12 months. But we also think that there could be some kind of V-bottom by late year. We will revisit this in a future webinar, but there's a strong, strong chance that we move very quickly from El Nino to La Nina, cooler than normal Pacific Ocean temps, by maybe September, October. And so this is important because, while the temperature of the Pacific Ocean does not correlate all that well in the United States or really in the Northern Hemisphere, it does correlate very strongly with rainfall patterns in Southeast Asia, Australia, Argentina, and southern Brazil. So generally the Southern Hemisphere, places that are surrounded by water, it's easy to forget that part of Argentina where a lot of corn is grown is very narrow. South America's landmass, so it really does, the Pacific Ocean temperature does impact rainfall patterns there pretty significantly. And that's what we found. I mean, the odds of a drought in Argentina next year are very, very high. And again, this will depend on the ocean temperature forecast and how that changes between now and September, October. But for now, we can probably count on 10 to 12 million ton losses in corn and soybeans. So Argentina will produce a 50 million ton corn crop this year. Next year, perhaps it's 35 or 40. Argentina will produce 52 million tons of soybeans. It's a very good year. Next year, it could be 40 million tons. And so 12 months from now, will the pace of U.S. soybeans and corn especially, the pace of corn exports be very, very robust? And do we start to sort of get through to the other side of this incredible oversupply? It's something that we're thinking about, and why we could see maybe a 5-year bottom in corn prices for last week of August, first part of September. And that might be 280 to 290, basis December futures, but that probably does reflect a multi-year low Argentine drought, southern Brazilian drought, will start the correction process from oversupply to probably more normal supplies moving forward. So that's probably what's next on the docket. As we get into the summer growing season, what does the potential for La Nina, how has that changed, and how do we start to ratchet or change southern hemisphere balance sheets in 2021 and that's beyond? So that's kind of the message. So it's all very much steady to lower for the next 3 to 4 months, with perhaps sort of a lasting bottom to be scored. So that's all for this webinar. If you have any emails or any questions, please email me. We're also offering a free week of our newsletter service if you get in touch with me. And after that, it's $1 for the first month. So essentially, you can have 37 days of ag resource analysis, which includes farm marketing advice and forward price guidance for just $1. And so we want you to make sure that you like it and get something out of it before you really commit to lengthier subscription. So again, if you have any questions about this presentation or anything market related, please send me an email. I thank you all for joining and watching this, watching the recorded version of this webinar. Thank you.
Tiffany, can you hear me?
Yes, Rich, they can hear you.
Okay, second here. We recorded this webinar and we will be posting that on our website here shortly. So if you or anybody else would like to view this webinar, please visit our website, midplainsag.com, and you'll be able to see this. We hope to keep having these webinars in the future. I think this is a really valuable service. We hope you find it valuable. So with that, if you have any questions for Ben, make sure to get a hold of him, or if you got any right now, maybe you could ask. Does anybody have any questions? If not, we'll stop this webinar, and again, check our website. And if you know anybody else that would like to view this webinar, please tell them, share our website address with them, and we'll be posting that in the next couple days. So thank you for attending.
Thank you, Rich.
Thanks, Ben.
Everyone have a nice day.
Yep.